Great pleasure now to bring on board Mr. T.V. Narendran, CEO of Tata Steel, to talk about how things transpired for the quarter gone by, what lies ahead, and how exactly is Tata Steel dealing with this energy shock, especially in Europe, which in a sense has blown everybody away with the kind of imbalances which are getting created. Mr. Narendran, fantastic to have you back, sir, on 18 Hours. Thank you for joining us. Before we get into specifics, Mr. Narendran, let's talk about the specifics for the quarter gone by. You've spoiled the market in Q1 and Q2. While Q3 was great, it was not extraordinary. Would you agree with my assessment?
Thanks, Nikunj, for having me on the show. I think Q3 was probably a tough quarter for everyone because, international prices softened. Domestic demand in India did not pick up as much as we had thought. And in Europe, we had the problem of energy prices, and the auto industry was struggling with the semiconductor issues. So for multiple reasons, there were cost pressures, volume pressures, and also price pressures. So everything came together in Q3. I think despite that, we've done reasonably well. So I'm quite happy with our performance. We could have done a bit more on volumes, on sales, not in production. I think production was strong, but we will see that additional volume flow through in Q4.
Is that energy shock which the industry witnessed in the quarter gone by, is that adjusted? Is that digested?
On energy, certainly Q3, if you look at Europe, we had guided 80 to 130 million dollars of euros of impact. Compared to Q2, I think the overall impact was actually about 130 million euros. So it was higher than we had thought. But still, we are not as impacted as many others because most of our positions are hedged. So, we are not really riding the highest costs. But I think there will be some more cost pressures in Q4 over Q3 as far as energy costs are concerned. I mean, reasonably flat, but the inventory, which is a high-cost inventory, which is lying there based on Q3 production, will flow through in Q4. So to that extent, you will see the material costs go up. Input costs, iron ore is coming down in Europe. In India, it has no impact because we have our own iron ore. Coal prices, the delta of Q4 over Q3 will be less than the delta of Q3 over Q2. So Q3 over Q2 was about $80 in India and about 80 euros in Europe. In India, it will be $40 for Q4 over Q3 and about 35 euros in Europe, Q4 over Q3. So we are seeing the impact of coking coal prices level up, though just now again coking coal prices have gone up. We will wait and see its impact for Q1 next year. But so far the costs seem to be tapering off a bit.
But are you also in a position to increase prices? Because for the quarter gone by, while cost went higher, there was an inability by steel companies to increase prices. Are we reaching a mean point where cost and pricing, or cost will be a pass-through in terms of price hike?
The sentiment has changed, Nikunj, already in the last couple of weeks for multiple reasons. I think the futures market in China is strong. The expectation is after Chinese New Year, things will start picking up. So the international prices are expected to move up, and that is reflected in higher iron ore and coking coal prices. Iron ore has gone to $140, coking coal is at $440. So that's also a reflection of the sentiment on steel prices. As far as India is concerned, the demand is improving quarter on quarter and month on month. And I think as the problems of the auto industry with semiconductors, both in Europe and India, start easing up, we see that also adding to the positive sentiment both in Europe and India. So I think we've reached the inflection point as far as the pricing is concerned, and the sentiment is more positive than negative. November and December were negative, but January has been positive.
So given that we saw a EBITDA per ton of about 28,000 for the quarter gone by, and now demand is coming back, energy costs are not increasing the way they increase in Q3, where will this number settle, sir?
So the EBITDAs in India will continue to trend down a bit, simply because a lot of the volumes that we're going to do in India, about 700,000, is going to come from exports. And export prices, which are basically what was booked over the last few months, will be lower than what we delivered in Q3. Because in Q3, you delivered on contracts booked in August, September, October. whereas in Q4 you'll be delivering contracts booked in November, December, and January. So you will see the impact of lower export prices and higher export volumes on the EBITDAs in India on a per ton basis. But because the volumes are higher, some of that impact will be offset. So overall, India, we are guiding EBITDA per ton will be lower, or rather the prices will be lower. And in Europe, we are guiding that the EBITDA per ton should improve simply because Europe will have the benefit of higher priced auto contracts and packaging contracts that we've renegotiated in November and December, which will flow through from January.
Mr. Narendran, while everybody has applauded the fact that you have embarked on a very strong deleveraging cycle, at some point in time, given that China is no longer exporting, demand is coming back, things are looking up even in the domestic market, government is talking about a large capex outlay, the demand is going to be coming back. So when does the deleveraging start becoming a leverage cycle, re-leveraging cycle purely based because of capacity addition?
Nikunj, we are actually well positioned simply because Europe and Southeast Asia, at least I said, which is left in Southeast Asia, Thailand, are now able to stand on their own and don't need any support from India. Right? That was our minimum condition. In India, the business is strong and typically the cash flows that we generate from the business can support its growth without having to leverage. The only time you need to leverage is when you go for inorganic growth, where you need a lot of money in a short period of time. But if you look at organic growth, and now we are well positioned for organic growth to go beyond 40 million tons because the Neelachal acquisition was basically because of that. Basically now with Neelachal, Kalinganagar and Angul or Meramandali as we call it, the Bhushan site, we are in a position to go beyond 40 million tons in India through organic growth in our existing sites. And I think that puts us in a very, very strong position because organic growth, the incremental organic growth is always at a lower cost. So scaling up costs will keep coming down. And the cash flows we generate from the India business, which you saw even in Q3 had a 38% EBITDA margin, can help us support these growth ambitions without having to leverage. So I think we are well positioned. Net debt to EBITDA is currently around 1. We have guided that we want to stay well within 2. And I think within that we can realize our growth ambitions.
So, if I have to break your answer down, it clearly means that you will deleverage furthermore because like you explained that you are in a comfortable position, all your organic plans will be taken care of. So if steel prices will go higher, additional cash flow will keep on reducing your debt.
We can. As you saw even this year, despite a lot of capital going to working capital because coking coal prices went up 3 times during the year. So even at the same efficiency level, a lot of money got stuck in working capital. Despite all that, we deleverage very strongly, right? So I think when working capital does not have an incremental requirement, because even at high coking coal prices, the incremental requirement is not there. And if the EBITDAs continue the way they are, there is a great opportunity to continue to deleverage. And we believe the Neelachal acquisition, we can, over the next few quarters take care of that from our existing cash flows.
Just to understand the biggest moving dynamic in the global market is that Chinese government are discouraging steel exports, something which we've referred to in the past. But China moving out of the global market as a source of supply. Would you be looking at encashing that and start creating more and more capacity which would be export dominated because now India and Russia they become 2 large export export destinations?
Absolutely, Nikunj. I think rightfully India's logical place to export from than China or Japan or Korea, which have been the biggest exporters in Asia, right? I mean, between the 3, they've been exporting more than 100 million tons of steel. So that's an opportunity available for India because India has the iron ore. And India has world-class competitive steel plants, not just in Tata Steel, but everybody else who set up a steel plant here. So I think it's a great opportunity for India and which was demonstrated last year. If you look at our export volumes, at one time the run rate was about 20-25 million tons when the domestic market was not picking up. So there's no reason why India's exports cannot be 20-25% of the production, if not more. And I think that's something all of us should try to do. Tata Steel has traditionally been at 10-15% exports. This quarter will be at maybe 17%, 16-17%. As we add capacities, we are happy to export. But normally the domestic prices are better than the export prices, and we have a very strong franchise with our distribution network and very strong equity with our B2B customers in auto and oil and gas. So oftentimes we are keeping pace with their requirements and exporting only when we are able to fulfill their requirements. But as we have these organic growth opportunities, I think we can certainly be a bigger and bigger exporter of steel as Tata Steel and as a country.
Let's spend a minute, Mr. Narendran, trying to understand the bugbear. And the bugbear last year was autos, whether it's semiconductor or supply chain disruption. Auto was not a great sector. Assuming that things normalize for auto this year, both locally and globally, how much of a comeback would that be? And how much of a steel production directly, indirectly is with autos?
So typically about 20% of the steel consumption goes directly and indirectly to autos in India, because apart from the direct supplies to auto, the auto ecosystem supports a lot of MSMEs. And today the sentiment has been a bit weak with them because the production volumes are not kept up with their capacities that are available. But I think that's going to change over the ongoing quarters. And more importantly, we are seeing commercial vehicles pick up after maybe 3 years. And commercial vehicles is very steel intensive. Passenger car is not as steel intensive as commercial vehicles. So that's a strong point. And I think given the focus on infrastructure, we expect commercial vehicles and the LME segment, which is the equipment which is used in construction, mining, etc., all that to also pick up. Construction, I think the outlay has been fantastic. 35% more on capital expenditure is good for infrastructure, good for construction. MSME sector is struggling still, and we hope that they will come back because they continue to need some support on liquidity. And like I said, once the auto comes up, they should be back on stream. So I think we are quite positive that overall the growth for steel in India should exceed the growth in the GDP in India, and that is the right place to be as a developing country.
Last time when we spoke to you about the direction in steel prices, you did indicate that steel prices will remain volatile, but the bias would be upwards. Now that was a conversation we had after the Q2 numbers. It's been a good 4 months after that. Has your view changed?
Not really, because if you look at coking coal price at $440, that's higher than steel prices of 3 years back, right? So if you have coking coal, which accounts for 40% of the cost of steel making at this price, and iron ore, which had come down to below 100 again at $140, $150, your input costs itself are significantly higher. Then on top of that, you look at energy costs like gas costs for those who are using gas. You look at all the, refractories, rolls, all the consumables that we all used to buy cheap from China. All that is very expensive now. So all the input costs have gone up. And I think apart from India, nobody else is really adding steel capacities. In Europe, they are replacing steel capacities, and those replaced capacities will be more expensive simply because you are going to use hydrogen and gas instead of coal. So I think overall the cost structure in the steel industry is going to shift. Exporters, big exporters like China, who were, I dare say, exporting even when they were not making money, are no longer going to be exporting. And so as a consequence, the steel prices will stay at a higher level than we've seen in the last 10 years. It will be volatile, which is unfortunate, but it will be at a higher level than what we've seen in the last 10 years.
But by and large, do you think that you are in a position to keep on passing the price hike now? Because there are times when you can pass on the price hike. In Q3, you struggle to do that. Do you think now that balancing or the so-called pricing power is coming back with steel players?
So again, in Q3, what had happened is the coking coal prices had started to drop and iron ore prices had dropped. So there was room for steel companies to pass on, or rather, in some sense, go with the sentiment which was impacting steel prices. So the steel prices started trending down. But the minute you see coking coal and iron ore price go up, you know that it has an impact. Because again, if I look at Tata Steel and some of my peers in India, our profitability is higher than many others because we are efficient and we have the advantage of raw materials. So at higher input costs, most other steel companies across the world don't make money, don't make enough money to reinvest in capital and things like that. So that pressure will be there. So I think there's a balance of between demand-driven price pull and a cost-driven price push. And this dynamic will always keep getting played out. The other dynamic, particularly for flat products, is between the domestic markets and international markets. Long products is largely driven by what happens in the domestic markets, but flat products will depend more on what happens in international markets. So these two dynamics will keep getting played out, and we will be watchful on that quarter on quarter.
Is this whole greenflation now hurting everybody? While it's good and great and important, and we need to be conscious about environment, but the whole transition of changing our fuel source, changing our fuel and logistics supply chain is coming at a cost, and that cost is causing greenflation.
Yeah, so that is there, and I think there are two things which is causing inflation. One is the fact that globally the recovery was faster than most people anticipated, and supply chains were not ready for it. Some of that will go away, just like we discussed semiconductor, just like we discussed, for instance, containers, container freight rates, etc. Some of that will settle down as more supply comes in and the supply chains issues are sorted out. But there are some structural changes, like you rightly said, as you shift from coal, which has been the cheapest energy source for many, into more expensive energy sources, because there's only that much you can get out of solar and wind for industrial production. You need alternate sources like gas or hydrogen or nuclear or whatever for steady supply for industrial processes. And as that happens, there will be an impact. Now, the thinking is that at the final consumer level, the impact may be less. At the intermediate level, it is higher. So, for instance, if you make green steel and it costs a few $100s per ton more, auto company may, in some sense, be able to pass on some of that to the final consumer, because the final consumer may have to pay slightly less, or rather, the incremental value of the final consumer will have to pay, I understand, on a car is maybe about $500. Right? So that is what is likely to happen. But I think what is also evident, particularly in Europe, is some of these are impacting consumers because of high energy costs at their homes, like electricity prices and gas prices. So it's something that governments need to manage very carefully. It's a complex transition. It's an expensive transition. It's a transition where the governments and industry need to work together to find solutions which are the most efficient.
Mr. Narendran, historically when steel prices or metal prices have gone up in this kind of a manner, the governments have stepped in. There are concerns which are raised by the ministry, there are concerns which are raised by various commodity consumers. Do you think there is a realization from the government and the consumers that, look, the steel price hike is a function of a lot of abnormal patterns of supply chain and demand which is causing to this kind of a spike? It is not really a pure profit motivation, because the thinking now, sir, will determine whether steel prices in India will go higher or lower.
Yeah. So Nikunj, I think like I said, flat products prices are determined by what happens globally. Like it or not, it will go up or down depending on what's happening globally. Long products is more a local issue, and it has been driven by the fact that there have been cost pressures on a lot of the smaller long product producers who account for maybe 40 to 50% of the long products production in the country. Right? So these are the two aspects which we need to look at. In India, if you look at it, steel prices, while it went up significantly compared to what it was, that was still the lowest in the world. And I dare say that a lot of Indian steel exports was possible because of the fact that steel prices in other countries, whether it's in Europe or in the US, were much higher than steel prices in India. So if you were exporting to those countries using steel made and produced and sold in India, you had an advantage, not a disadvantage. So I think some of these things are more and more evident to people. I think what is a bigger concern is the volatility, which I totally agree with. And I think one of the suggestions we had there is also to say that if the customer is a government, can there be some index pricing where in the volatile environment, if there's a price increase for the smaller contractors who are doing work for the government or smaller OEs, MSMEs, can they get the benefit of that? I mean, can they pass it on? And similarly, when there's a price drop, the benefit should pass on. So it's not that, because people are tempted to take positions, because in a volatile market, you can make a lot of money if you've taken the right position. So that also makes it more complex. So I think we need to deal with volatility rather than the absolute price. I think the problem is more volatility than the absolute price.
Okay, so that's the word coming in from Tata Steel management, acknowledging that Q3 was a tad bit soft, but they're expecting additional volumes to come by in Q4. The EBITDA per ton might continue to trend downwards when it comes to the India business. Tata Steel holding up in the green around the 1200 mark, but don't lose sight of the markets because we are shifting lower at the low point of the day as we speak, below the 17,300 mark. While SBI continues to hold up in the green, it's the banking names which are coming under pressure. Nifty Bank down about 450 points. HDFC Bank down almost 3%. HDFC Life coming with a cut of around 3%. And names like Bajaj Twins are also trending lower. We'll do one thing. We'll slip into a very short break, but don't go anywhere. We'll continue the market action on the other side.